Markets, meanwhile, I think Reliance is the real engine stock today. It's getting some company from Tata Motors. Banks today are not doing cartwheels. Insurance stocks are doing just about okay. Later in the day, we'll hear from Maruti, Britannia, Axis Bank, and also Bajaj Finance. Important set of numbers. Vibha Padalkar joins us now, Managing Director and CEO with HDFC Life. Vibha, good morning. Thank you for joining us. Now, another good quarter. What has led to the strong new business premium growth and the APE growth?
It was actually a combination of several factors. The fact that all our partners started getting back to normal after the phase one of COVID. And also we had the technology in place for us to be able to reach out to customers even if they did not want a face-to-face. Plus our bank assurance has been firing extremely well. And as you know, they are part of the exempt services. So most of the branches were open and even if customers were not walking in, but transactions were happening on the back of that, outreach to prospective customers happened. Also in terms of our agency business, if you were to look at after a little bit of a tepid start, it picked up steam and ended quarter four at a phenomenal 49% year-on-year growth. And so did some of our other channels, say our broker channel. So all of it came together. Plus we had new products. We did launch our new term product, Click to Protect Life. Some of our group products as well in the form of Group Poorn Suraksha. And we were able to also engage with our partners through technology for them to in turn engage with their customers. So I think all of that came together to give the kind of growth of 40% in a standalone year-on-year basis. To your question on margins, we continued on our strategy on a balanced product mix. And that helped us deliver the margin upliftment that we saw in the standalone quarter, as well as a reasonable amount of eking out expense efficiencies. So for the standalone Q4, our NBC or VNB as it is known, value of new business, grew by 52%. And standalone margin for quarter four was 27% versus 24.3% of quarter four of the previous year.
What really has been the impact of the second wave? And it's unfortunate, very, very unfortunate, but it's a pure business question. The number of cases are more, the number of deaths are high. Are you getting a sense that this could, are you getting a sense in terms of the insurance claims now?
Absolutely. We are watching this second wave very, very closely. And, you know, the good part, if you like, is that the mortality rates haven't gone up very significantly. In fact, they are about 50% of the mortality rates of phase one of COVID. So right now we're trending at about 0.7% as against about 1.4% in phase one. So if that were to hold on, so a lot more people get infected because COVID 2.0 seems to be a lot more infectious, but hopefully the death rates are not as bad. If that is how it pans out over the next couple of months, then we should be okay. Nevertheless, we have for FY22 strengthened our COVID reserve, anticipating a bit of a spike in the death rates. And we have set up 165 crores that we are carrying forward for FY22.
Ms. Padalkar, the embedded value has shown a growth rate of about 29%. What will be the key drivers going forward and what kind of growth can you expect here in FY22?
The correct metric to look at for embedded value, and that's how we ourselves look at that metric internally, is the return on embedded value or embedded value operating profit. So we ended FY21 at 18.5% versus 18.1%. So embedded value operating profit leaves out the investment variances. I think you're referring to overall growth in embedded value, and that includes investment variances, and we did have a fairly significant amount because of the fact that equity markets as of 31st of March 2021 were a lot more buoyant than where we were a year previously. So I think it's better to leave that out because that's not a management controllable outcome. And so looking at EVOP percentage is perhaps the right way of looking at it. And to summarize, we ended there at 18.5% versus 18.1% previous year.
And in terms of your product mix, is it safe to assume that protection will likely drive growth? And what is the outlook on your overall product mix going forward? How do you see protection ULIPs shaping up?
So we've always believed in a balanced product mix, and it's very core to our strategy. That helps us tide through a lot of ups and downs, whether caused by macro events, whether caused by a pandemic, or some regulatory changes to our business model or customer preferences. And I'm happy to share that in FY21, we again stuck with this philosophy of having a balanced mix. And so we ended FY21 at a unit-linked share of 24%, a participating share of 34%, non-par savings were 31%, protection was 7%, and annuities was 5%. This is as close to the ideal product mix that we would like. And so we're already there. In terms of going forward, we'd be happy to increase the protection share and annuity share and consequently bring down one of the other categories. But largely, that's how we see this even going forward.
Okay. And give us a sense as to what the outlook is in terms of market share, because HDFC Life has managed to increase market share to about 15.5%. Which are some of the areas that have helped you gain in the market? What are some of the key trends that you're witnessing?
We don't really have market share as a target. It's more an outcome. Various initiatives that we continue to drive within the organization, whether it's in terms of tech innovation, integration with partners, new products, having a balanced product mix. And all of that put together is what leads to the outcome, which is market share growth. Yes, we did have a market share expansion of 130 basis points from 14.2% to 15.5%, and thereby ended number 2 in the private space from being number 3 last year. But really, it is all our channels that started firing, especially in Q4. So after a tepid start in Q1 due to the pandemic, all our channels, including our bancassurance channel, as well as, for example, our agency channel, which also exhibited upwards of 50% growth, and some of our other channels also, like our broker channel. So it was really a culmination of all of those aspects, and also some of the segments, for example, apart from protection, our annuity in Q4, that segment grew by 53%. On a full year basis, that segment grew by 46%. So really, it is a sum of several things that came together that gave the kind of market share increase that you mentioned.
And, on account of COVID, what are some of the key consumer trends that you have observed that you believe will be long lasting? Will we see some of the higher premium rates for customers and higher insurance rates for insurance players?
On the key trends, we are seeing that some of the smaller, the tier 2 and 3 towns also starting to see an uptick in terms of being our customers. So some data points that I can give you, for example, web aggregators, tier 2 and 3 via this channel is up quite significantly. And today, as much as 80% of people in tier 2 and 3 towns buy their protection through web aggregators, as against perhaps 69% in tier 1. So we are seeing a deeper penetration wherein people can access and buy insurance sitting in the comfort of their homes. Similarly, if I were to look at tier 3 in terms of versus tier 1 and 2, we used to have a very different ratio, but now we have tier 1 is about 34%, tier 2 is about 26%, and quite surprisingly, tier 3 we have been able to make inroads at about 40% in terms of overall our term share. So that kind of a shift is something that we are seeing. To your other question about reinsurance rates, right now there is no explicit conversation that are in the offing. But I'm sure that reinsurers will also look at how the pandemic and how mortality rates are panning out and the entire COVID signature. And then they will take a call, because theirs is also a business. And we are amongst one of the fairly reasonably priced reinsurance rates that we enjoy as part of the developing world. But nothing specific as of now.
And how much of your business and customer acquisition has been done digitally? The company has also said that digital is going to be the backbone for the growth story. What kind of a shift can we see in your overall business model with this pivot to digital?
Absolutely. Today, if you look at our what we call digital, so if you earlier it used to be just people who directly come onto our website or through the aggregator website, which was loosely called as online. But we are evolving into a hybrid model wherein even our channels, like say our bancassurance channel, 40-45% of the transactions that are happening via that channel are through digital. And is through online banking, for example. So matters are getting, quite blurred in terms of what is termed as digital and what is a face-to-face mode of sale. And that's where we have showcased a whole host of tech-led offerings, including in some of our traditional channels like our agency channel, wherein we have a pre-approved sum assured and we are able to upsell to customers. We are able to onboard our agents as well entirely through digital modes. We are able to service customers entirely digital. So that entire ecosystem of digital is what we were trying to portray, and we've given a lot of illustrations on what we have done over the last year in our investor presentation.
Thank you so much for taking time out and joining in with an outlook on your earnings as well as the digital shift that you're seeing in the growth strategy. That's HDFC Life for you. Let's take a very quick break right here on the show. I'll be right back in a bit with Chartbusters and lots more.